Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Mr. Jonathan Twomley. And we are going to talk about the commercial mortgage market and what might be a brewing liquidity crisis. I've been reading some articles about folks stepping back from funding, buying, selling of these securities. And I thought I would talk to Jonathan because A, I don't really understand him, and B, I know he is in the mix. So, Jonathan, how you doing?
I'm doing great, Michael. How are you?
I'm doing well. So I have read some articles about the commercial lending market becoming more difficult, more challenging. Uh, I'm going to call it a liquidity crisis. It seems to be drying up. Things are not trading, but I don't know if that's true.
So,
And again, my understanding is, that deep.
yeah, well, as luck would have it, I just interviewed two different lenders yesterday for my podcast. So
Oh,
I have
nice.
some very recent information, which is pretty fresh.
Okay.
Um, yeah, so there is not a crisis in commercial lending,
Hmm.
but there are a couple things that are going on that are making things more difficult. So, for example, there is something called CMBS right now, where
Yes.
uh, that is a commercial mortgage-backed security. And if
Hmm.
you remember, one of the things that caused the housing crash was mortgage-backed security, where all of these housing loans were packaged. Supposedly, it was going to be super safe because it was
Yeah.
diversified, and
I
the
remember.
idea that all of these loans could not possibly default at once, and that was into this new thing that was couldn't fail, and of course,
Couldn't fail. Yeah. Yeah.
well, so there's a version of that for commercial mortgages called a commercial mortgage-backed security. And the craziness did not happen with CMBS that happened with MBS, right, in
Okay.
the last recession. So there were some defaults, but it was about 1 to 2% of commercial mortgages that were in the CMBS program defaulted. That was enough, though, to make lenders nervous, but it didn't cause a crash by any stretch. Um, Now, what's happening right now in the CMBS market is you have a loan originator who originates these mortgages, and then they turn around and they sell them to end investors, and they're packaged up, right? And they're sold to end investors who buy them just for this secure, safe cash flow, right? And basically, they're just building in a spread, right? So um, these are for very conservative investors who are happy to get 2% or whatever, as long as they know they're getting it, right? And so these CMBS mortgages, I mean, I've done a number of them, and they are designed to be cookie cutter, right? They have, like, your mortgage must fit these boxes. You must, as a borrower, fit these boxes. Like, you can't deviate from any of it. It's not like going to your local community bank where the banker is going to, like, look in the eye and suss you up and say, yeah, I trust you, and give you the money, right? CMBS is like, it doesn't matter. This is just like a box ticking exercise, so that all the mortgages are cookie cutter and they are exactly the same, and they can be sold in these tranches. Now, what's been going on is that because of the rise in interest rates, the the back end market for CMBS deals has basically dried up, because what people are worried about is the rise of interest rates, and therefore the fall in value of these securitizations, right? Because, as you know the corpus of these debt instruments is affected by the interest rate. So the higher the interest rate goes, the less people are willing to pay for these things, because they need the interest rate to rise on them, right? The effective interest rate. So they can take a beating if interest rates go up too much. And so right now there's just no market for these. So the CMBS market is basically dried up. Now, how does that affect the commercial market? Well, CMBS tends to, uh, even though I just said a moment ago that it tends to be very conservative and very sort of like lockstep. CMBS actually is available to lend to kind of riskier deals that the agencies won't lend on, right? So, and the way that they try to square that circle is by boxing you in as the borrower, right, and making sure that there's all the security that's attached to these loans. So, it does affect sort of some more marginal deals, deals with maybe less experienced borrowers, or deals in just categories that are sort of disfavored by other lenders at the moment, right? So so it's really affecting that. So that's that, but that's still like a relatively small piece of the lending market, right? What you're seeing instead, though, and I was talking to these lenders yesterday, the banks are flush with cash, right? Equity investors are flush with cash. Preferred equity investors are flush with cash. The problem is that at the prices that the sellers are still asking for, you cannot make your debt service coverage ratio that's required by the banks at the normal 75 or 80% loan to value, right? That's the real issue that's happening right now. The reason the banks are in good shape is because after the financial crisis, they instituted some pretty strict underwriting requirements. For instance, the requirement that that your net operating income must be equal or greater to 1.25 times your debt service, right? So, and that's like, they can't move that, right? So as your interest rate goes up and your debt service goes up, your payment goes up, well, that NOI has to go up as well. And since NOI, for the same amount of leverage, if that NOI ain't going up and it doesn't go up over, and they're underwriting on what's currently there. Like, you can't tell them, hey, we're going to do this value add and it's going to be higher. They're like, we don't care. What is it now? Right? That's what limits the size of your loan. And what's happening right now is that because sellers have not cut their prices, they're starting to, we can talk about that too. They're starting to cut prices because they realize that there's no way out of this. But prices are still high relative to what the debt costs, which means that now you're getting, instead of 75 to 80%, you're getting 60% top, sometimes 50% loan to value. And most investors don't have that much equity to draw on to fill out that capital stack. They can turn to preferred equity, right? But it's still, it just makes it very difficult to make these properties make sense, right? So that, sort of, that there's not a liquidity problem in the market, but there is liquidity crisis. There's no liquidity crisis, I should say, but there definitely is a problem where the cost of the debt makes deals, not worth doing.
Yeah, when I look at what I'm hearing in the commercial MBS market, the non-QM residential market, it's really all the same thing, and it all goes back to the Fed. Essentially, these deals can't be priced, or there's a disagreement on price, and hence no or limited transactions. I've been hearing from non-QM lenders that their portfolios are stuck, right?
Mm-hmm.
They put these together, all these houses, they're trying to sell them off to Wall Street. Wall Street used to buy them at a 7, and now they want 8.5, and there's just a lot of disagreement. I think this all boils down to the Fed, to people not knowing where the Fed tops out. Is it 5 terminal? Is it 6? Is it 6.5? We did get a good. Go ahead.
I didn't mean to cut you off, but so what's going to happen here is, once everybody has certainty about interest rates, it'll just reset around that level. But
exactly.
the problem is that the loans that got, underwritten at lower interest rates, right? Basically, those tranches are going to take a haircut.
Exactly.
In order to sell those loans off, when the market finally reaches the new equilibrium and everybody feels like, okay, they know where things are, they're going to take a bath on those because they're going to have to sell them at a big discount.
And that's why it's slowing down today. That's why deals are slowing down, because everybody expects the terminal rate is almost there, and they don't want to take that haircut. So yeah.
And they're going to take them on the earlier ones that sort of got caught in
exactly.
between. But they want to limit their damage and
exactly
new loans, right? So this is what's happening in this market. But everybody should know that, like, there is no liquidity crisis in the commercial space right now, but there's definitely a pulling back. Bridge debt too. There's a lot of bridge debt lenders are also pulling back for the same reason. Their borrowing costs have gone up and they don't know where these things are going exactly. And and everybody knows too that there's going to be some, especially people who took bridge debt, short maturity bridge debt, or variable rate bridge debt, and didn't buy rate caps, or even if they did, if they bought they might have a 3-1-1, with a 3-year term and 2 extensions, but they only were able to buy a rate cap for the first 3 years. And in order to get the extension, the lender is going to tell them they have to buy a new rate cap, and that may be hundreds of thousands of dollars.
That's a big number.
They can't raise. So there's going to be a lot of stuff coming on the market next year where there is the seller is under some level of distress. And the good thing for the overall health of the market is that the lenders are going to be made whole, right? So they will keep on lending. The deals they're probably not going to be selling these properties for less, as short sales, but there's going to be a lot of equity that gets swiped out because
I agree.
Structures. So, but the lenders will keep on lending, which is good. But there are going to be some people who get caught short because they bought, a deal at the top of the market and they can't refinance, and it's going to be tough. So
very, very cool. Well, Jonathan, thank you for the education. I appreciate it. Where can people find you?
Yeah, so I am in the process of redoing my whole sort of empire, right? My Facebook group, you've heard me talk a lot about my Facebook groups, and thanks, lots of you have joined. We are actually going to consolidate all my Facebook groups, free and paid, into one single group called the Apartment Investors Club. So please go to Facebook and join the Apartment Investors Club. Be sure you answer all the questions there, because the bot will kick you out automatically after an hour if you don't. But here's the thing. If you are patient, we're going to let everybody in on November 21st. So get on the, get your approval questions asked now. When you get in there, you're going to get a free video series all about how syndications work, how to get good deals from investors, how to raise money from people, and how to have the proper mindset to be an investor. And on top of that, if you put your email address into the approval questions were asked, you don't have to, but if you want to, you'll also get my free download, which is my ultimate checklist for how to do your first 100-unit deal. So all that free stuff just for joining the group. And we're going to have a smaller, tighter, but much more engaged community, because all the dead weight will be gone. And I'm really looking forward to seeing you guys in there where, you can interact with me directly. So come and join Apartment Investors Club on Facebook, and I will see you there.
I'm actively joining right now on my phone.
Awesome.
Thank you so much.
Sure.